Hi, everyone, and thank you for joining us today for our webinar, Buy Now, Pay Later, Consumer Insights. My name is Kelly Blount, and I will be today's moderator. With that, let's go ahead and get started. I'm going to turn things over to Todd Moore, Director of Education with Trinity Debt Management, to introduce himself and take us through today's topic.
Great. Thank you so much, Kelly, and thank you to everyone joining us this afternoon. We always appreciate you joining us in our webinar series. Great to be back with everyone. Today we have, I believe, a really interesting and timely topic for you. Buy now, pay later. So this is a product that is certainly changing, significantly changing the way that the retail market works, the way consumers are able to access and finance products, and really just changing the way that we interact with different services and how we make these larger purchases, smaller purchases through this new structure, buy now, pay later. What we're concerned with today really is its impact. You know, whether or not that this particular type of finance model, buy now, pay later, what's its benefits, what's its risks, and then also introduce you to some of the current credit scoring changes that are coming this fall in 2025. So a lot to cover this afternoon, and let's just dive in. So when we think about buy now, pay later, this is an installment loan. So it divides purchases into multiple payments, often equal payments. You make the first payment, and then you have several, what we call pay in four is the one that's kind of the common model right now, but you make a payment, and then there's usually 4 payments in total to pay for that particular product or service. So what we're looking at here is an installment loan, and it can vary in terms of the types of services that you purchase or things that you're trying to finance, but it usually doesn't charge an interest rate, allows you to make these charges through time over 4 payments. And then the question is, at some point, how will this impact our credit? So we're going to be looking at that towards the end. But right now, when we think about approval, unlike traditional credit cards, approval for these types of services, while we have these kind of finance schemes set up, the approval has always been through a soft credit pull. Unlike a credit card that has a hard credit inquiry, where you actually apply for a credit card and have to have a minimum score and things like that to qualify, we know that that doesn't operate the same way in the buy now, pay later market. So in this case, what we're looking at is a credit score through a soft pull. Credit score is not entirely dependent for this type of service. It's often attached, the payments are attached to a debit card or to a transaction through your bank account. And then what they're looking at there is past purchases or outstanding loans. The approval criteria is pretty low in this case. So there's good reasons to look at this in terms of how this functions in the market, whether it's good for our economy, whether it's good for consumers, and whether or not down the road this type of product will either have some benefit or detriment for you in terms of building credit long term. So right now we know that there's changes coming, but as it's operated since 2019, very limited credit capacity can apply for these types of products, buy now, pay later, and finance different items. So where we see this product, to share some, kind of how this market evolves and where we're at now. So we have to really go back to about 2019 to kind of get a good gauge on how this is changing through time. So we look at I look at this Bank of America report, and you can really see that it's projected to just continue to grow since 2019. I'll show you a couple examples as well how it's just continued to take off. But there's several factors here when we think about why this market continues to grow and expand. You know, what are those factors? And I've listed 3 for you here. Financial flexibility. So it's very easy to defer payments without accruing any type of interest. That's a very attractive part of this particular model. So if you wanted to finance something, you have 4 flexible payments. defer that payment over the 4 payments and then not accrue interest, you can see why that particular financial flexibility is particularly attractive. A lot of studies, at least in the Bank of America studies, show younger folks as well, what we call Gen Z, millennials, folks that are not really using traditional credit lines or have built the type of credit that they will need. They're newer to credit, are using these types of products. And I'll show you some data on that as we move through the slides, but financial flexibility is a big part of this tool. E-commerce integration, so it works. What we mean there is that it's this seamless integration into retail checkout. It makes it easy for retailers to tap into this type of market. Everything from purchasing a pizza to financing and repair, all sorts of different things that can be just integrated into the retail market, particularly in terms of retail sales. Clothing is a big part of this right now, computers, refrigerators, anything that can be tapped into this market and used to expand products and services. Folks are looking to use that integration in the market, so it continues to expand. And then the economic climate as well. I talked about 2019 and how that works. Fintech companies looking to work with retailers to try to expand the market, move some products and services. What they learned is that folks are very much interested in that flexibility, that it can be a market that can really move products and services along to consumers. So what we see is we're now kind of looking at this market and wondering, okay, what's the future of this market? We know it's growing, but at the same time, does this really work in the best interest of consumers, or what potential risks are around the corner? And we'll be looking at that today. So if you're looking at these types of products and services, and I've only listed 4 here. These are kind of 4 big players in the market. There are many new ones emerging. Affirm, Afterpay, Klarna, PayPal. There are many others that I said, but Affirm, and I will talk in particular about Affirm as we move further into the presentation, but Affirm, unlike some of the others that are listed here as providers, is now working to start reporting data to the 3 major credit bureaus. One of the interesting things about the providers that are listed here is that with the new FICO model, there still isn't clear regulatory guidance on how this will work and what its credit impact will be. But Affirm has taken steps, and I'll share that research with you. Affirm has taken steps to work with FICO to try to create a model to capture your activity, how consumers use this product, to report some of that information to the credit bureau. But I wanted just to point this out. As this market has expanded, these are 4 of the big players in the market right now. You can see that each of them offer similar services. Some of them have some variation on how, whether or not they're focused more on retail or products that are more service-based. But you start to see where, Affirm has really tapped into the retail market. That's one of the areas they really, so e-commerce is a big part of that model. PayPal, I think we're all aware of how that functions in terms of paying for things, but then they're also breaking up. I'm sure you've seen how they break up purchases as well. So these are some of the providers. There's going to be probably growing influence in this area, but you can start to see where they kind of differentiate themselves in the market for these types of services. So consumer benefits and risks. This is really interesting. So when we look at, who is using this and what's the potential benefit and risk of this particular product, there's pretty consistent research when you look at the market, pretty consistent data that shows that younger folks, millennials, are financing products and services through buy now, pay later services. When we start to look at some of the data itself, so incomes, they looked at income less than 50,000 per year. Certainly, kind of the trends that we see there is I mean, that's a pretty big gap for a lot of our economy in the 50,000 range. So that means that it's not just millennials using this product. I don't want to make that appear that way, but younger folks are certainly using it. The reason for that is, one part of that is that they have what we call a thin file, or they haven't built the types of credit they would need to access the traditional credit market. So this provides some flexibility. And on the other end of that, we have folks who've had some credit constraints, so they start to use that. So in this study, though, they looked at, whether or not that you have, what is your spending patterns, your income, cash balances. They start to try to create a profile of the types of folks who are using these types of services and how it will apply. And one of the things you see here, and this again, immediate access with deferred costs. So you're empowered with instant access to goods and services. You spread those out over time. You have a payment structure, again, that allows, without having an upfront financial burden. So these things here are these perceived advantages. So if you have someone that is newer to credit, younger folks, probably between, I would say probably 22 to maybe 28 years old in that group. Maybe they haven't built, they're out of college, or they're in college, you're trying to finance some type of item where you haven't had a credit score that would qualify you. Again, having that immediate access is very attractive. And then, as we talked about before, interest rates and those, having really kind of 0% interest to be able to finance something, again, allows for that budget-friendly payment solution. Now, you'll start to see, though, why I've chosen this word perceived, because what we'll see down the line here is that we're not usually talking about folks who are just using buy now, pay here to make, one or two purchases. Where the risk really starts to come in with this particular product is that with that ease, lack of credit score requirement, this budget-friendly payment, that's perceived, also comes with a great deal of risk, and we're going to point that out here in the coming slides. So when you're using this, one of the things that happens is that, late payments do accrue, you can get fees, that there's interest that will tack on to these types of loans. While it seems very attractive, interest it starts interest-free, but late payments, you're going to get hit with some fees on the back end of that. There's always, and this is consistent across all the research, this debt accumulation risk. So when we're looking at this particular product, again, the ease of using it, credit scoring requirements, those sorts of things, what we're seeing is that the market understands the ability to kind of tap into multiple plans. So I laid out in that slide the four big players: Klarna, Afterpay, Affirm, those sorts of things. Well, what we find is that folks, they don't just settle on one particular provider. What you find is, again, with the ease of accessing those various platforms, we have folks that have multiple plans, and that's where we start to see the real risk of this particular approach start to emerge. So we have multiple payment obligations across multiple services and multiple providers, and that debt accumulation risk is what is really, it's not only just a policy concern, but it's a concern for us who are trying to do good things with, making you aware of what the benefits and pitfalls of this, or risks of this particular product are. But that debt accumulation is a significant concern within the market and for us as consumers. And then again, I'll be hitting on these themes kind of repeatedly, but that credit score implication with buy now, pay later providers, again, there's not consistency in the market at this point. So you'll see that while we do have new changes with the FICO models that are rolling out, providers don't necessarily have to report. There's not consistent regulatory guidance on that, at least not at this point. So we're heading into 2025, fall of 2025, and what we see is that while some of those FICO changes are in place, again, whether they report or don't report, that's kind of still a gray area. It's not completely settled at this point. But what we will see in the future is that missed payments are likely, they will hurt credit scores. So this market is moving, it's changing. So if you're using this product or service and you think back about 2019 to 2025, it's been fairly easy to access the market, but there are significant changes heading our way. Now, when we look at the impact, I wanted to show you just a pretty simple graphic here, but it makes the point. We've got this color coded by basically how is this product being used? How are consumers responding to it? So you'll start to see across these areas. So basically that the dark blue that you see here, the one that's the largest on this frequency distribution table, what you start to see is across whether or not that folks are in the red, what we're saying is that they have used it. So you start to see that just incrementally it's going up. So the red is, in the last 30 days that folks have started to use this product, it just continues to expand. And you're seeing that across all three of these lines. The light blue, whether particular retailers have offered some type of benefit, you start to see moving to the right. You can start in that light blue column, you start to see that it just continues to increase. And then have you used buy now, pay later? Folks that we're looking at here in that darkest blue, again, the trend lines are all the same. They're all pointing to how the retail market is just being reshaped by buy now, pay later. So again, going back to these conversion rates and how this is kind of just consumer insights, what we're seeing is using these types of services, it's easy for retailers to have a higher what we call a conversion rate. So basically by offering, you use PayPal or you use Affirm or one of the other service providers, buy now, pay later service providers, you can really move some products along. So, you think back again about COVID-19, things are not moving. This product is a quick way to tap into moving some products off the shelf. But now what we're seeing is that folks, the market is really responding to this. So they know that by offering this particular service, and you're going to see it probably more in the future, by offering that, it does convert to sales. Again, these lines are all going up. They're all changing. The average value of what purchases are costing now is starting to change, and it's a really, in the research, what I found is it's a really broad range, everything from things that are smaller expenses to where we're starting to see where you can make kind of larger purchases on this as well. It's kind of targeting, the market's being targeted to folks now where if you can make that payment, they want you as a customer. So more and more services are coming into this market to be able to provide, allow you to finance things with kind of larger, that cost a little bit more money, breaking those payments down. It used to be that they were kind of smaller items. You're going to start to see some of these average values are going up. And then one other part of this is, while millennials and younger folks are a big part of this market, what's attracting more and more retailers into this market is that it's expanding their customer base. And they're looking to build brand loyalty. So you'll start to see a lot of retailers see this as a way to really kind of lure you into their products and services to be able to make multiple purchases through this type of buy now, pay later approach or financing scheme. So the market, again, very much in tune with this product and service. Now, a couple things about the market itself. So thinking about how this really functions in terms of just the economics of this approach, what folks have, I looked at FTC data, I looked at the Federal Reserve and some other things just to try to get a good feel for how this is working, some of the market implications, because the product obviously is very attractive. Retailers, consumers are all using it. But what's the economic impact of this? We know that people are making money, it's expanding the market. Short term, we know that there's going to be economic stimulation from this type of approach. It's expanding. The retail sector continues to grow. Those things drive economic growth. So we look at that. We think that's a positive. But because we don't have that regulatory structure in place and the rules are still evolving in terms of how things are reported through FICO and whether or not companies would be required to report that type of data as they would in the credit card market, the longer term is that we have to be very cautious about a potential debt cycle that could emerge from this particular approach. So we've had credit bubbles in the past. We've had an uptick in defaults or default rates that really cause a lot of problems in the economy. So one of the things that you start to see here is regulators, Congress, and particularly economists are really doing a lot of work in this area, trying to figure out, as attractive as this particular product looks, are we looking at a potential credit bubble that will burst at some point and create some havoc for a lot of individuals and families, if not create some problems in the credit market long term? So those are just some things to think about as we think about how this potentially impacts economics in the future. Now, I've talked a lot about the regulatory part of this. So whether or not that there would be, FICO is the first with a firm to kind of move into this direction. Without the regulation, again, the market's kind of left to whether or not basically people pay or not. There's not a consistent way. So having FICO take a look at this and do a study, this is where credit scoring really is important. You want stability within the market, and you want that for consumers as well, so that if they're taking on installment loans, if you're taking on an installment loan, we want to, if there's activity that can be captured in a positive way, we want that to be reported to build our credit score. So we don't want things that are just not working to our benefit, our economic benefit. Right now, that market, as I said, is just kind of transitioning. And then different sectors, when we look at consumer spending, whether or not that, how will this kind of trend into other retail sectors? Is it going to be a positive or negative? Okay, so I think when we think about this product, you look at some items like computers or refrigerators or other things that you might finance, that's one thing. Where regulators are looking at this is, again, if I have multiple buy now providers and consumers are looking in those areas to finance all sorts of different products and services, is that an emerging debt problem? So let's take this a little bit further. So what we think about here, want to shift now to, that's kind of the market and the economics. Let's shift now to consumers, to us who are using this product and service. So we're going to look at what may be benefits and risks for us as consumers, okay? So when we think about this product, again, while I've talked a lot about younger folks using this, it's also important to think about folks that have financial constraints. So if you think about someone who's had post-bankruptcy or someone who's rebuilding their credit history in some way, had some type of financial hardship, a buy now, pay later service, it does have the capacity or the potential to help consumers break down payments into smaller installments, not be dependent on a credit score, and help them to finance something where they would not otherwise qualify for traditional credit products. So used responsibly, and that's asking a lot, okay? But when we think about that, as a consumer, that offers a lot of flexibility. And again, that's why we see it growing and emerging in the market as a product and service. But these perceived purchases, one of the things we see here with financial behavior is, again, we project our future earnings much more than they probably are. So when we take on all these various loans, there's that risk of overspending, having debt accumulation or default. And I think that's where I get very concerned about how this functions in the market at this time and how it may function without having stronger credit score requirements is that there's always that ability for us to project our future earnings and wind up having significant debts. You know, and we find this a lot when I work with folks through Trinity. I find this particularly with folks who are trying to improve their budgeting and trying to figure out how to get out of debt. What I start to see is looking at transaction history, how they use their bank accounts. When I start to see that there's, 7 to 9 buy now, pay later accounts attached to their debts, that's what keeps them from being able to pay off other credit cards, or that's what puts a car loan or even their home at risk. So while things are incremental and it's easy to obtain these sorts of services, the longer term impact for debts and overspending is significant. I mean, there is significant, I can't even overstate it enough. I've seen it to the point now where I start to see that it puts larger financial goals certainly at risk. And then we think about whether or not these installment options, for me, I look at whether or not these installment options, we're going to talk about this towards the end. If buy now, pay later is a great product, it's a great product compared to what? We'll talk about how that's compared with credit cards on this slide. So we think about buy now, pay later. It's not the concept itself, while it's been kind of injected into the market since 2019. Some folks would say, well, we've had layaways and other things in the past that they've kind of emerged into this market with buy now, pay later. Does it function like a layaway plan or something else? Well, unlike the layaway model and a credit card, you take immediate possession of a good. So there's no delayed payment with it. So as a consumer, you get that immediate gratification when you apply, you get the product. And then when you think about credit cards, again, these are structured as installment loans with there's no credit check, it's zero interest. The flexibility, again, so easy to tap into that market. The question then becomes whether or not this actually can build a score, whether or not that you benefit financially from even taking on these particular types of products and services. I think what you start to see here now as we move through these slides is that there's significant risk. When we think about the data trends, that's what this information is showing us. What we're seeing in terms of how this works is that buy now, pay later consumers, their assets tend to be on the lower side. So savings accounts, and there's a lot of numbers on this particular slide, but what we look at here is, again, credit constraints move folks into this particular approach, maybe not the credit to go into a traditional credit card of some sort or a small loan that you obtain through the credit union. So you use this to get that immediate product and service that you need. Yes, there is some positive to that. There's also risk. When you look at the data trend here, what you see is the folks that are really attracted to this, again, finding a creative way, tend to have either a credit constraint or less access to cash to be able to purchase things. And then when they are using these, the trend here again is that relying on this approach, again, when you get into this particular approach, what you start to find is as this goes up in terms of your usage and you getting into debt, that limits your ability to either pay off debts that would improve your credit history or to strengthen your score long term. So the data trends, again, are pretty clear. Taking on this product comes with significant risk. That's really what I'm trying to say. Other things that the studies have shown, I've talked a lot about the credit scores and why folks would want to use this type of product and service. A past bankruptcy also. We know past bankruptcy, there's no way to really tap into the credit market at that point. Scores too low to qualify, so again, it's attractive. We know that folks that take on these types of loans, they will compare with non-users of these of accounts. When you look at comparison groups, we know that folks that are carrying buy now, pay later accounts will have more debt than those who are opposed who are not on average. So a lot of that reflects, I think, credit capacity and probably even usage. But particularly for folks who have filed a bankruptcy, there's a lot of reasons why that folks would have to look at a buy now, pay later scenario, because they're looking, if someone needs a refrigerator and they can't finance any other way, that's one thing. But by using this or relying on this to get certain items because your credit score is lower, that's where you start to see you're actually moving yourself closer to a potential debt problem, or even defaulting on other loans that you may have. So I wanted to talk just for a few minutes. We've trying to cover a lot of ground here with you today, but one of the things we've looked at, again, not a consistent regulatory structure, talked a little bit about the impact of who's using it, data trends, the types of services and others who are attracted into this market. Again, an evolving and expanding market for this particular approach. And then trying to focus also, again, to kind of just caution you as someone who may be attracted to these types of services, just to be careful. When we looked at Consumer Financial Protection Bureau, this study goes back a couple years, but it's pretty much in line with everything that I've looked at since 2022. That inconsistent consumer protection. So that is, right now, if you have a credit card, something goes wrong with that, you have the ability to dispute, you have the ability to have disclosures on your credit report that talk about certain hardship provisions or credit freeze and all those sorts of things. None of those rules really, at least we're still waiting to see what the final rules will look like this fall of 2025. None of these things apply with buy now, pay later. So those things do not apply. There's a lot of what we call data harvesting. So they take and they sell this type. When they're doing this type of data work and they're harvesting the types of consumers, looking at what you purchase, what you buy, what you finance, that data is sold to others. They use that to find ways to start to market products and services potentially to you. So there's a concentration of that kind of data that's being used to, for a lot of folks, they see that as an invasion of consumer privacy. And then again, I've probably overstated it at this point, the risk here of just debt accumulation or just being overextended. In my own work, as I've said, I'm seeing this creep in more and more, where in addition to a high credit card balance and having just significant debts, maybe being overextended on credit cards, once borrowers get to that point where they can't obtain any other credit, then they start to shift over into buy now, pay later, where the credit scoring requirements are minimal, sometimes very, very limited. And then now we've got both high credit card debt and 7 or 9 buy now, pay later accounts. I mean, we are in significant trouble. So again, another data point here for you of why we need to be extremely cautious using this particular approach. So talked a little bit about the financial markets itself. I will say this about the systemic risk. Again, this is kind of big picture policy stuff, but because of the way that we have this idea of what's called phantom debt, it's potentially for delinquency rates. So I thought, again, it's similar to this theme that I talked about earlier. You have a car loan right now, maybe through the credit union, and you're taking on some of these types of approaches. I mean, this really can put you at risk for managing maybe a car loan, or if you have a home loan, other credit cards. That systemic risk we're talking about is really the market risk, but these types of debts, again, it creeps back in the big picture, this can become a very big problem. So when we auto pay for debit cards, this is one of the things, with the credit union we've talked a lot about using auto pay and budgeting. Here, what we're talking about is you use auto pay to finance a buy now, pay later loan. Well, in the budgeting concept, what we're trying to do is set it up to reduce outstanding debts. We set up, the automated budget that we've talked about in some of our other budgeting presentations. We know that automation, auto pay can have some tremendous benefits for paying off debts. Buy now, pay later requires oftentimes that auto pay from pulls from your bank account to make payments on these types of loans. What I've seen is it's often very difficult to close that down. So let's say that you've set up payments and then you're late or you've missed payments. They will pull from your account. Sometimes it's really hard to stop those payments. If you've overdrafted or you're setting something, you want to stop the auto pay and you just want to make a payment. Again, that's where this market is kind of tricky. It's sometimes hard to get those things closed down. It's hard to stop the auto pay structure. That's where those rules, as we talked about before, are still kind of murky, and why we need that regulatory structure in place. And then again, just the ability of these things to just turn delinquent. Seeing it more and more, the larger number of these accounts that you have, the more likely, other accounts are likely to be at risk or for you to be delinquent on those accounts. Now, we talked about some of this as well, but without having buy now, pay later loans being reported, and many of them are not widely reported, what we're going to find is that the financial markets are trying to clean this up. I believe that it's at this point, it's really difficult to say how this will work long term, but with the new FICO scoring requirements that we see, there is potential to capture some of this activity so that we don't have widespread problems in markets where folks start to default on loans long term. But until we get this problem corrected, what you start to see again is that non-reporting is leading to overconsumption. We're using this product too much, and then again, starting to see larger and larger groups of consumers go further and further into debt. You start to see where I'm going with this. Well, let's get into credit scoring now, because I think this is, for most folks, one of the things that they're probably very much interested in. So there's been, I mentioned this earlier, but among those providers, Affirm has been very much one of the leaders, really, as a buy now, pay later provider, to structure a partnership with FICO and then really work towards trying to capture all those things that we talked about, non-reporting, disclosure, things like that, trying to fix some of those problems. There is concern with overspending and overconsumption and just the ease of this product. The data, as I've shown you in multiple slides, is really clear. While there are some benefits, there's significant risk in using this, okay? So Affirm has really done I think, a pretty good job of working with FICO to try to conduct a study, figure out if they can fix these things. So what they did is, I think there was about 500,000 folks that went through this. They looked at lots of data and lots of how consumers are actually using these products. At the end of the day, what they did was, their research basically said that, we could create first and foremost, they'll create a new score calculation using buy now, pay later. That did not exist prior to this study, okay? That's what I was pointing out in those prior slides, is there just wasn't the structure in the market to do that. So this is coming in fall of 2025. I want to make that very clear. If you were using a buy now, pay later account, this is important. In those previous slides that I showed you, we're talking about how the market functions and whether or not it's reported. It is going to start to be reported coming this fall. So there will be some shifts coming. The full impact I can't really give you at this point, because There's still a lot of gray areas in how this is going to work. Honestly, it's still a little murky for me, even trying to work through this myself. What we do know is that a new model is being created and that there are steps in place to try to capture activity for it to be beneficial, to capture your payment history so that it's beneficial to your score. So what they're trying to look at is if you're using this product, whereas it was not reported before, under this new FICO model, we'll capture that activity. We can have improved payment history and potentially increase your credit score, improve your score. Now, we don't know how that all functions yet because it's new. What I will say is, just like in any other, we've done a lot of work on credit scoring and credit reporting through our presentation series, and I encourage you to go back and look at some of those. But what's very important here is, while this model is being conducted, again, we know all the risks in the market. When you create a new score and a new scoring model, you're capturing payment history. That works two different ways. One, in a positive, if you're making a timely payment, that's treated as a positive. But if you're using this and you have 7 accounts and you start to run late or you default, you can see with this new model that, as you would find in the credit card market, a late payment does have a detrimental impact on your credit score. So this becomes very, very important for our discussion today. If you're carrying multiple buy now, pay later accounts with these new rules in place, knowing how that market has functioned, now's the time to start correcting your behavior, start thinking about budgeting, start thinking about your score, because these future payments will be captured differently. And that can be both a positive and a negative in terms of long-term credit scoring. So we'll talk a little bit about that. So again, kind of hit on these two standards, but the major credit bureaus right now, they are planning. They still have not clarified what that will be. FICO has already set the model in place, but the 3 major credit bureaus, TransUnion, Equifax, and Experian, they plan to bring these types of loans into their credit reporting standards. So when you pull the credit report post fall 2025, again, I can't give you an exact date because this just was reported. We know that activity will be calculated into your credit score. So what they've done through that model, the credit scoring models that, 5 factors still remain the same. But what they've done as part of payment history and outstanding debts, they've created an additional variable there to capture some of this activity. We don't know what that actually will mean in terms of how it will impact the score. And to be honest, where I'm very comfortable with a lot of the other payment history, credit cards, installment loans, those sorts of things, it's going to be really interesting for me to see how this really functions longer term. Experian Boost was one of the things that was talked about widely as capturing your either rental payments to improve score. They created, a variable in payment history to do that. I didn't find it to be all that significant in raising scores, capturing this activity, because the amounts that we finance right now are kind of fluctuating. How will that work? How will late payments work? We don't know. But what we do know, and what's important for you to know, is that how these loans, things are changing. These will be reported in terms of your payment history and outstanding debt or defaults. Those types of loans, buy now, pay later loans, will be calculated into your credit score. So, so what does all that mean? Well, with this proper reporting, like I said, we kind of covered some of this here, but with proper reporting, I would say proper meaning that activity is captured in terms of payment history and outstanding debts. What that means is it serves a couple different purposes. One, it tells the market whether or not there is some systemic risk or larger debt problem that's occurring in the market. For a retailer, if you start to see high defaults, then this product or service is something that you should probably watch. What we've seen in this research, as I've shown you in the previous slides, is that those trend lines are just straight up. They're moving. We haven't really seen folks defaulting at the same as maybe as predicted. Folks are making payments. Um, it's interesting to see where it goes from here because folks are now able to use so many different services. Um, whether or not there'll be a long-term systemic risk to that, the data will show through this new reporting model. And then whether or not how this functions for us as consumers, whether or not it actually will enhance our credit score. Those are all questions that we don't particularly know yet. So um, let's look at this model just kind of quickly and kind of get a better feel for what we're looking at this fall of 2025. So again, we'll have what's called the FICO 10 buy now, pay later, and FICO 10T, 10 as in looking at trend lines. I'm not sure because this is so new. I'm not even sure how far differentiated these two models, the 10T and the 10 are, but certainly capturing activity through the buy now, pay later is all captured into this particular approach. We know it's coming available in fall of 2025. And then we also know that it's up to Experian, Equifax, and TransUnion to determine when they make that information available. So again, I wish I could be more specific with you on the call today. I cannot. That's where we stand right now. But there's plans it will work a little differently than credit cards. So while credit cards is, again, one of those things that's reviewed under the FICO model, payment history, outstanding debts fall into that. Buy now, pay later will start to be reported as a variable. And then, the hope is that the model reflects, trying to modernize the model, bring this particular product and service in. But the goal here is to reshape and be able to use activity to actually build credit. That's certainly one of the goals, is that if you have 130 million consumers taking out these types of loans, it's certainly time to bring forward a model that captures activity, positive or negative, so that we know how this model really works for consumers and whether or not we can build credit capacity from it. Another part of this was what we call the credit invisible. So if you take someone, again, ideally, that has had a hardship, had a post-bankruptcy, looking to improve their credit, or someone that has not built credit over time using this particular service, there's 25 million, projected 25 million consumers that are lower income earners that have a very difficult time building credit history. This can become a product potentially to use this to start to build a line of credit that you could then later have a score to qualify for a loan through the credit union, and then continue to build your credit capacity through time. That's all these incremental steps through time to be able to really improve your credit history. So by capturing everything in that new model, there's the potential, anyway, that we can bring folks that are not even in the market right now into the market, build their credit capacity, get them the types of loans they need through the credit union, and just continue to expand their capacity, even potentially to the point of home ownership. So there's a lot of good that can come from creating a stronger model and having the scoring side, but it also can come with some risks for us as well. So in our few minutes, and I know we have covered a lot, I've given you lots of data points, and I like to share a lot with you, so I appreciate your time, but wanted to share with you how this market works, who's participating and why, and hope you get a good feel for those consumer insights. Tried to share that with you a little differently than some of the previous presentations, but it's really an expanding market and lots of changes. What do you need to do before you consider using this? I mean, a lot of folks have already used this. We start to see that again. I see it through the office, but should you use it? Is this something you should consider? Well, if I haven't made it already clear, one of the big things here is that overspending is just very, very much a part of this, particularly when you are relying on it again. If you're struggling in other areas of your finances, or if you have a financial plan. We talk a lot about budgeting through our webinar series. Do you want to start an emergency fund, or you want to pay off debts, or you want to create some other financial goal? You really have to consider what those financial goals are before you start going down the path of buy now, pay later. What you're taking on in terms of debt and overspending, potentially overspending, what you start to find out is, those goals can't really be met. For every dollar that's going into these type of finance schemes, you're really, one loan is one thing, having multiple loans is another, and it won't take long to really fall into this category where you're going to regret some of those things that you're trying to finance. I won't go through all these statistics here, but missed payments, whether they regret a payment or not, or just really what you see as the big numbers is just that they start to have payment problems. That just, the more of these types of accounts that you carry, the more likely you are to miss a payment or to have fees or to get yourself into a longer term debt problem. And I talked about Gen Z and millennials and those sorts of things, but you start to see 66% that were part of this bank rate survey from 2025, March 2025, 66% who were taking on, younger folks taking on, the most common problem was that, they're starting to miss payments and just having just problems making the payments, overextended. So be cautious about that. I want to caution you against loan stacking. This is where you're taking on multiple loans at a time. Again, multiple providers in the market, but loan stacking is basically, the more of these that you take on, the more likely it's going to be difficult for you to make all the payments to pay them off. So you're increasing what you owe, and as these things begin to be reported, post fall of 2025, as this activity starts to be reported, having multiple lines of buy now, pay later loans as an installment line, that really could hurt your score. We don't know what that full impact will be, but missed payments would hurt your payment history, and then having multiple loans with your credit utilization, the amount of debt that you carry, that also, because it's all part of your score. So those two factors, by carrying multiple lines, can really lower your score. And then again, this is back to that projection error that we make, kind of a behavioral thing. Splitting payments. Again, we always assume we'll have more money in the future than we probably will have. We don't account for those risks that are around the corner. Splitting payments, while it's seen as a way to finance and break things into smaller payments, the installment amounts, you see very clearly that, particularly, I use this example on purpose. Black Friday, 48% more using it to finance. You spent more than you would have otherwise because you thought you could pay it all off quickly. So you start to take on multiple buy now, pay later loans to finance all sorts of different Christmas presents or other things that you want to use for Black Friday, not accounting for the hidden costs or other potential risks that are with buy now, pay later. And then just lastly, again, looked at this journal of marketing, and I think this kind of summarizes in many ways all the things that we're talking about. Okay, we've spent really this last hour just talking about how this market's evolving, what it means, how the credit score requirements are changing. If there's anything that you take away from today, there is at least 5 years of consistent data that using this product, okay, Journal of Marketing, Harvard Business Review, FTC, I can't overstate it enough. What we see is that buy now, pay later is increasing consumer spending. It's pretty clear. Again, the flexibility of those payments being broken up, there's some benefits there, but what we're finding is, again, feeling that we can manage more than we probably can is leading to overspending, and at some point you start to feel those financial constraints come back into your budget. You're overextended, you get yourself further and further into debt. So I cannot emphasize it enough. Just use caution as you're using this particular service. I won't go through this because we've talked about this again, the benefits and the credit risks. I think we've made that point tonight, today. But one thing for us as we close, and I'll take some questions, Kelly. With the new credit model, I think we're very clear on on overspending and loan stacking, those sorts of things. But one thing is that if you're using this, whether or not this is going to build credit or not for you, that's an open question for us. As this new credit scoring model takes place, whether it will build credit or not, and what that true impact will be, because the bureaus are not reporting it consistently, we don't know how that score will if it will be a positive on your credit report, how much it will be. Until these payments are actually consistent, then it's hard for us to project what our credit score will look like. What I would imagine, though, is we'll find ourselves in a scenario potentially where there will be some adverse credit impacts, because payment history, outstanding debt, utilization, as it functions across all things credit, these types of services are going to make their way into the credit score itself. So if you're looking, again, for some alternatives, what I want us to look at is, let us help you with a secure credit card, or let's talk about a credit builder line of credit, maybe even if you could qualify for a personal line of credit, as opposed to maybe using things to purchase through buy now, pay later. These are things that will have a longer term impact on your overall credit score and credit capacity. So if you are looking for alternatives and want to build credit long term, I'm going to ask that we, let us work with you. Whether you're thin file or just need some assistance, let us work with you through the credit union. Let Trinity help you, as well as we partner with the credit union. And let's try to get a better feel for where we're at with these buy now, pay later loans. I hope you have a greater understanding of how this market functions and some of the benefits and risks, but also let us help you build your credit long term. I think what you'll find is that if we do that, as opposed to the short-term gains you'll have with buy now, pay later, the longer-term gains of using other products and services will be much more beneficial to you. So we have covered a lot. That is our time. Kelly, do you have any questions for me?
Yes, we have just a few questions. We'll try to run through them fairly quickly. Our first question says, how can I tell if a buy now, pay later provider is reputable and safe to use?
Yeah, well, I mean, one of the things that we have right now is, I would say, as far as reputable or safe to use, the ones that we listed in the presentation, these are some of the key players in the buy now, pay later market. And I think what you'll find is there's probably about nine total key providers in the market. I would rely, if you are going to use this service, use the ones that we looked at today, those big four, Klarna, Afterpay, PayPal, things like that, because those are the ones that have been in the market the longest. Those are the ones that are going to be more likely to start reporting and want to start reporting to the credit bureaus. I think if you start there, I think that those are probably the ones that you're going to find that are most concerned with being within the regulatory structure and meeting those credit scoring requirements that are coming. So if you're not certain, you just don't use those. Look for another provider that has that stability and that's been in the market. If you start there, I think you're at least halfway home if you start there. I think that's the best way to go about doing it. Just if you're not certain, don't use the service.
And then we will end on this question. It asks, are there any hidden fees or interest charges that consumers should be aware of with buy now, pay later?
Yeah, and I tried to highlight a few of those. I know we talked about a lot, so it may have gotten lost in some of this, but again, things start off with zero interest, but what you find is as you make the pay in four, you will start to find there's fees really kind of hidden, not only for the retailer, the retailer pays a fee to the company. You also pay a fee for using these types of services. So there's two sets of fees. You most likely eat that cost from the retailer as well. But the interest rate can be as high as 36% for for late payments. And then, I mean, that's a really large number for interest. And then also in terms of defaulting and things like that, that certainly would be reported. So, but in terms of fees, what's usually done with these types of accounts is that the fees are kind of hidden in that pay for four scenario, but non-payment is really where you start to see the fees really creep in. That can be as high, again, as 36%.
But with that, that is going to conclude today's webinar. Thank you all so much for joining us and have a great rest of your day.